Bags. Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem of how to properly record notes receivable, as well as the accrued interest involved and the collection on it. So if you're unfamiliar to notes receivables, don't fret gang, I dropped a link to get you up to speed in no time. So with that being said, let's get it. So it tells us that December 1st, Kyle Corporation accepted a 60-day, 9% $12,000 note receivable from J. Michael in exchange for account receivable. And the requirements are to journalize the transaction on December 1st, journalize the adjusted entry, and a collection on a note of principal interest at the maturity. All right, gang. So we already know about note receivables. Those are considered long-term assets that the company holds on a book longer than a year. But unlike accounts receivable, note receivables involve interest. And so when we're on the notes receivable end, we understand that that interest we receive is considered a revenue, which means that at the end of periods, we must accrue for those revenues earned that we haven't received the cash yet. And so this particular problem is going to walk us through the life of this particular note from the time it was initiated to the time that we collect on it. So let's get to it. Requirement 1 tells us to journalize the transaction on December 1st. So what happened on December 1st, gang? Well, we converted an account receivable into a note. So obviously something went on where it wasn't supposed to be with our customer and we didn't collect. So now we're going to charge some juice. And when I mean juice, I mean interest. But in order for us to do so, we have to create a note. So therefore, we're going to take accounts receivable off the books and put a note receivable in its place. So we're going to debit note receivable J. Michael and credit accounts receivable J. Michael for the $12,000. We are going to check the answer. Fantastic. Next, it tells us to journalize the adjusted entry needed on December 31st. And it told us to use the 360-day year for our calculation. All right, gang, easy breezy. We know that at the end of the particular period, there's some interest that has been earned, but we haven't received the cash for it. Why? Because this is a 60-day note that started on December 1st, and the maturity date of this note will be the following year. So as of December 31st, we've earned some interest revenue that needs to be on the books for that time period. So first, we need to accrue this interest by simply debiting interest receivable and crediting interest revenue. But we're halfway there, gang, because we have to calculate the proper amount that's earned. And we're going to use our interest calculation in order to do so. So we know that the interest calculation is simply just your principal times the rate times the time. Remember, gang, time must be annualized at all times. So we're going to take our principal amount of $12,000, multiply it times the 9% interest, and we must accrue for the time that the interest we earned from revenues. Therefore, it started on December 1st, and now it's December 31st. So that's 1 month of interest gain that we actually earn revenues for. So for our time, we're going to utilize the 365-day as mentioned in the description, and we're going to divide that into 30 days. And once we calculate the interest, that should give us an amount of $89. We're going to check the answer. Excellent job. And last but not least, gang, we're going to record the collection on this note that takes place the following year. So we know that it's a 60-day note, and we know 1 month of that has already been accrued. Therefore, there's 1 more month left. So this particular note should mature at the end of January the following year. So now we're at the end of January and we have to record the collection on this note. And one thing's for sure, we're going to receive a cash amount including principal plus interest. We also must consider, now that we received the interest, to remove the interest receivable as well as the note receivable off the books. So let's do so. We're going to debit cash and we're going to remove the interest receivable off the books with a credit. We're also going to remove the notes receivable off the books with a credit as well. Now, gang, we know that notes receivable principal amount was $12,000, so we're going to go ahead and put that in there. We also know that the interest receivable last year that was accrued was an amount for $89. Now, gang, our cash amount, as we said earlier, is principal plus interest. So we know our principal is $12,000. But to set that aside, we have to calculate the proper interest that's due. So how are we going to do that? The same interest formula that we did to accrue for our interest. So we're going to take the $12,000 times 9% times 60 days over 365, gang. And that should give us an amount of $178. So once we add that total interest to the $12,000 principal, our cash amount should equal $12,178, gang. And my spider senses are tingling, and it's telling me that you guys know that this particular transaction is not done. Why? Because our debits and credits aren't equal, but more importantly, we have some interest for this year, revenue of course, that must be recorded because we've earned 1 month of interest. Therefore, we have to put that interest on the books. So we're going to credit interest revenue for that 1 month, which we already know to be $89. We're going to check the answer. Excellent job, gang. So there you have it, gang. A quick, easy illustration of how to properly record a notes receivable, including the initiation of the note, the accrued interest, as well as the collection on that particular note. So if that light bulb was clicking, which I know it was, hit the like button, smash the subscribe button, and share the channel with your friends so they can chase the bag as well. I'm Dr. Who, and it's always a pleasure to share your time with you, gang, and I'll see you soon. Bags!